From port jobs to America's overall jobs picture, economists trying to gauge whether last Friday's hot employment report will push the Fed toward another rate hike at next week's meeting. Joining us right now is former Fed Governor Daniel Tarullo. He is now a professor at Harvard Law School. And Dan, let's talk this through a little bit. A little bit of something for everybody in that jobs report on Friday. What did you take away?
Yeah, I had the same reaction, Becky. I think where one began when one started reading it was probably where one ended up when one had finished reading it. So if you were inclined toward a pause, you saw a little bit in there which would have reinforced your instinct. And if you were inclined to think that another 25, 50 basis points is needed, you would probably find something in there as well.
As somebody who's been in the room, how do you think the FOMC will read it, and how do you think they'll react at the meeting this month?
So here, Becky, I think they've got a bit of a communication issue. A couple of weeks ago, there was a fairly widespread expectation that there was going to be a hike. And it seems as though the Fed leadership, Chair Powell, and especially Governor Jefferson, of course, as the vice chair designate, seem to have gone out with messages that a pause was quite likely. And people kind of shifted to an expectation that next week we're going to have a pause or a skip. If they turn around now in the light of one print, the employment print on Friday, I think that's gonna make it look like they're sort of shifting back and forth based on just one piece of data, which isn't great for their communication strategy overall.
So we had someone who said they expected a pause at this meeting, but then maybe a rate hike in July. Does that fit with what you would expect?
Hawkish pause is the phrase that people are using. And of course, they can communicate that a couple of ways, but they're not exclusive of one another. One, of course, it will be Powell's press conference, but the other is what's the dot plot going to look like? Will you see a higher projected end of year point for the federal funds rate? It's difficult to predict, but I think probably right as we sit here this morning, this is the most likely outcome, that you do have no increase in the funds rate next week, but there are one or more indications that another one may be coming absent a pretty favorable turn in the data coming in the next 6 weeks or so.
Hey, Dan, you were the Fed's financial regulatory leader in terms of the reform after the financial crisis. There's a story in the Wall Street Journal today that suggests the bigger banks could be facing 20% boost to their capital requirements. Does that sound like a good plan to you? I don't know if you've seen the actual details in the story.
Yeah, I saw the story. The word details is the key one here, Becky, because the Basel III endgame regulations are complicated even by Basel standards. And so how precisely they're going to get implemented may make a significant difference from bank to bank. It's pretty clear that the biggest hits will be to the trading book and to the operational risk of banks that rely substantially on fees as opposed to interest rate margins. How much those are, and importantly, the degree to which they get offset by changes in the stress test are details that I think we'll only know once the agencies come out with their formal proposal. But it does, everybody who's been looking at the agreement that was reached a number of years ago in Basel thinks that there are going to be non-trivial increases. Probably into the double digits. How far into the double digits? And how much variability across banks remains to be seen.
It also mentioned in the article today that one of the things they're considering is knocking it back down, the amount of assets. If you're $100 billion instead of $250 billion, which would be more in line with what you did with Dodd-Frank. That seemed like a good idea to you? Yeah,
well, for sure. On two counts, I think you absolutely have to do something with the 100 to 250 billion regionals on available for sale securities and liquidity regulation, the things that were at the heart of the SVB and Signature problems. Whether and how much capital should be raised, I think is an open question that, in my preference, would be decided by a good stress test that they would take every year. I should say, Becky, I wouldn't expect that the Basel III endgame changes would have an especially big effect on the smaller regionals, the $100 billion regionals, even if they're back in to these capital regs and the stress test, just because they don't have lots of trading activities and they don't have, well, some of them do, but most of them do not have a lot of fee-based income.